Welcome to Penrose Learning, where we make understanding easy.
You start by locking down prerequisites so development is fast and safe. First, secure high-quality historical and live market data and test API access. This is non-negotiable. Once done, provision compute, cloud GPU or low-latency co-located server, and encrypt keys and storage. Finally, choose the model scope. Are you building signals, risk overlays, or a portfolio optimizer? Define clear KPIs like Sharp, max drawdown, and execution latency, so early experiments measure what matters. You now implement models and iterate quickly while validating assumptions. Begin feature engineering with price lags, returns, volumes, and macro indicators. Standardize and check leakage. Then train simple baselines, moving to tree ensembles or sequential deep models when justified. Compare with cross-validation and walk-forward tests. Make sure to include transaction costs, realistic slippage, and market impact in backtests. Once models pass, add execution rules and risk limits. This keeps live behavior predictable and reduces overfitting surprises. You finish by moving to production with caution and clear controls. Deploy to a staging environment and run paper trading while monitoring latency, PNL attribution, and risk metrics. Only promote after consistent performance. Automate retraining schedules, drift detection, alerting, and a quick rollback path so deterioration is reversible. Implement governance, audit logs, access control, compliance reporting, and periodic stress tests. If live results deviate, check data pipeline integrity first.
Thanks for watching. If this was helpful, leave a like and consider subscribing. See you next time.